The recession isn't coming. It's already here. The official numbers just haven't admitted it yet. And here's the thing, they never do. By the time the government officially calls a recession, you've already been living inside one for months, sometimes over a year. So while every headline is telling you the economy is fine, your grocery bill, your credit card balance, and the people around you quietly losing jobs are all telling you something completely different. One of those two stories is lying, and today we're going to show you exactly which one. And real quick, if this is the kind of conversation you want more of, hit subscribe right now. Because this channel breaks down what's actually happening in the economy in plain language before the headlines catch up. Now, let's get into it. Now, here's something most people have never been told about recessions. They're never announced while they're happening. The National Bureau of Economic Research, the official body that declares recessions in the U.S., doesn't make the call until months, sometimes over a year, after the recession has already started. Think about that for a second. The 2008 financial crisis, the recession officially began in December 2007, but it wasn't declared until December 2008, a full year later. By that point, Lehman Brothers had already collapsed. Retirement accounts were already gutted. Families had already lost their homes. The 2001 dot-com recession started in March, wasn't declared until November, 8 months later. You see, this isn't incompetence on anyone's part. It's just how the methodology works. They need a full set of confirmed data before they'll make anything official. And collecting that data takes time, which means right now, today, you could be living through a recession and the government won't confirm it for another 6 to 12 months. And that raises a very important question. If recessions are always declared after the fact, what are the real early warning signs right now? Because they exist, and they are flashing. Let's start with unemployment. Because 4.4% sounds manageable, right? Uncomfortable, but not catastrophic. Here's what that number actually measures. It only counts people who are actively applying for jobs and haven't found one in the last 4 weeks. That's the whole definition. The moment someone stops applying, they stop being unemployed. Statistically, they just disappear from the data entirely. And since the pandemic, more than 1.6 million Americans have done exactly that. They gave up. They stopped looking. And those 1.6 million people are not in that 4.4% figure. They're not in any figure. At the same time, labor force participation, which tracks how many people are actually in the workforce, has dropped nearly 1.5% compared to where it was before the pandemic, meaning a large group of people who were working in 2019 are simply no longer in the picture. So the real unemployment situation is worse than what's being reported, much worse. And if you think that's the worst of it, we're just getting started. Because even among the people who are counted as employed, a growing number of them are barely holding on. Over the past few years, something has been quietly shifting in the labor market. Full-time jobs are going away, and part-time gigs are taking their place. Now, here's where the government's tracking gets interesting. If a full-time worker gets laid off and then picks up 2 part-time jobs to cover their bills, the government records that as 2 jobs added. That's net job growth in the official numbers. And even counting it that way, 2025 only produced 181,000 net new jobs for the entire year. That's already a weak number by any standard. But when you understand how those numbers are being built, it gets even weaker. Right now, 4.4 million Americans are working part-time because they can't find full-time work. These people are technically employed, but they don't have the benefits, the income, or the security that a full-time position actually brings. Full-time income gets replaced by two part-time checks that don't add up to the same amount. Benefits disappear. Stability disappears. But the headline says, job growth. Okay, so jobs are weaker than they look. But hold on, people are still spending money, right? Consumer spending is still up. The economy is still running. So maybe things are actually fine? That's where the next number comes in. And this one should genuinely worry you. At the end of 2025, American credit card debt hit $1.28 trillion. That is a record high. And the average interest rate on those cards is sitting right around 22%. Now, the media loves to spin this as consumer confidence. People are spending, so the economy must be healthy. But spending more is completely different from earning more. Right now, people aren't spending because their income went up. They're borrowing to cover the basics. Groceries, rent, gas. The things that used to get handled with a paycheck are now going on the card because the paycheck isn't stretching far enough. And here's why. Cumulative inflation has risen over 25% since 2020. The dollars in your pocket today buy 25% less than they did 5 years ago. Wages haven't kept pace. So the gap between what people earn and what things actually cost has been quietly filled in with credit card debt. And that 22% interest rate means anyone borrowing just to survive is now paying what amounts to a penalty on their own financial situation. So when you hear that consumer spending is strong, ask the next question. Is it income-driven spending or debt-driven spending? Because right now, it's built on borrowed money. And borrowed money always comes with an expiration date. And the savings data confirms it. Historically, Americans saved around 8% of their income. Through different economic cycles, 8% was roughly where things held. Today, the personal savings rate has dropped to 4.5%. People aren't building cushions. They're draining the ones they had. The safety net that was supposed to absorb a financial shock is getting thinner every month. And this combination, record credit card debt, collapsing savings, wages that can't keep up with inflation, this is textbook pre-recession behavior. Households stretching themselves to hold on to a lifestyle that their actual income can no longer support. It works for a while, until it doesn't. You know, we've seen this exact setup before. Back in 2007, the same headlines were running. Consumer spending is strong. The economy is resilient. 8 months later, the financial system was in free fall. Right now, the consumer side of the economy is being held together with borrowed money. And here's where things start getting even more serious, because the same pressure that's squeezing households is also hitting the corporate world. And what's happening on that side is something most people haven't seen yet. Commercial bankruptcies rose over 7% last year, crossing 24,000 filings. That is the highest level in over a decade. And here's the context behind that number. During the pandemic, a lot of businesses survived on cheap money. Interest rates were near zero. Credit was easy to access. And a lot of companies borrowed heavily just to keep the lights on. But that era ended. Rates went up. Refinancing became expensive. And companies that were already running on thin margins are now hitting a wall they can't get around. So when you put this all together, weakening labor markets, consumers maxing out on credit, savings evaporating, businesses filing for bankruptcy at a decade high, you have to ask a serious question. Why do the official numbers still look okay? Because that's the part that really matters here. And it's the part most people never get a clear answer on. Because the answer isn't that the economy is actually fine. The answer is that the way we measure the economy has serious blind spots built into it. And some of those blind spots didn't get there by accident. The unemployment formula has been around since the 1940s, and in all that time, the core definition hasn't changed in ways that help. Work 1 hour a week, you're counted as employed. That's it. Drive for a delivery app for 60 minutes. Employed. Senior engineer at a major tech company. Also employed. Same bucket, same statistic. The GDP has a similar issue. It counts credit-driven spending the same way it counts income-driven spending. So when people borrow money to buy things, GDP goes up even if those same people are sinking deeper into debt every month. The output number looks healthy either way. And inflation measurement? The Consumer Price Index, the main tool used to track inflation officially, has been adjusted multiple times over the decades. Things like substitution effects, where the formula assumes that if beef gets too expensive, you'll just switch to chicken, get quietly built into the calculation, so the index drops. But your grocery bill doesn't. Now there's a principle in economics that explains all of this. It's called Goodhart's Law, and it goes like this. The moment a metric becomes a target, it stops being a good metric. Once policymakers and institutions start managing a number rather than managing the reality that number is supposed to represent, the number drifts away from reality. Every time. And here's how that plays out in the real world. The unemployment rate stops being about actual employment quality and starts being managed to keep the headline number low. GDP stops measuring genuine economic health and starts being used to show growth at any cost. Inflation stops tracking your real cost of living and starts tracking a formula that's been softened over decades of small adjustments. This is how your lived experience ends up having nothing to do with the official reports. The gap between the data and reality doesn't just open up randomly. It builds quietly underneath the surface until the pressure gets too big to contain. Now here's the data point that ties all of this together. The leading economic index, a composite of indicators specifically built to predict where the economy is heading, has declined for 6 consecutive months. 6 months in a row. That same pattern appeared before the 2001 recession. It appeared before the 2008 recession. Both times, the index started declining quietly while the official story was still saying everything was fine. And it's declining again right now. You see, one bad metric on its own, you can explain away. Bad month, external shock, temporary blip. But when this many signals are all moving in the same direction at the same time, labor participation falling, job quality declining, credit expanding at record levels, savings shrinking, bankruptcies rising, and the leading index dropping for 6 straight months, that is a pattern. And this pattern has historically shown up in the period right before a major economic contraction. Every single time. So what do you actually do with all of this? First, stop waiting for the official announcement. By the time the NBER declares a recession, you will have already been living in one. The people who come through economic downturns in the best shape are the ones who read the real signals early and made moves before the crowd did. And to do that, you have to learn to read past the headlines. When you see job growth being celebrated, ask about job quality. Are these full-time positions with benefits, or are these part-time gigs propping up a weak number? When you see consumer spending called a sign of strength, check whether it's income-driven or debt-driven. When inflation numbers come out, Compare them to what your actual cost of living has looked like over the past 5 years. Your grocery receipts, your utility bills, your rent. Because the economy being reported right now and the economy people are actually living in are not the same thing. And the people who got hurt the most in 2008 were not reckless people. They were people who trusted the official story for too long. They believed the headlines. They assumed the professionals were watching the right numbers. By the time the recession got officially declared, the damage was already done. You know, the recession doesn't show up with a press release. It shows up in your bills, in the job listings that aren't there anymore, in the number of people you know who are now working 2 jobs just to stay at the same level they were at before. It shows up in the data if you know what to look for. And right now, the data is sending a message that's hard to ignore once you actually look at it straight on. The NBER will make the official call eventually, and when they do, it won't be news. It'll be confirmation of what anyone paying close attention already understood, because that's how it always goes. The question that actually matters right now is simple. When the dust settles and the numbers finally line up with reality, which group do you want to be in? The people who saw it coming and had time to prepare? Or the people who were still reading the headlines and waiting for permission to take it seriously? That answer is yours. Now, if this video helped you see what's actually happening under the surface of this economy, do me a favor, subscribe to this channel and hit the notification bell so you don't miss the next one. Because this is what we do here. We break down the real numbers in plain language, without the spin. And drop a comment below. Tell me what you're seeing in your own life, in your own city. Because some of the clearest economic data doesn't come from government reports or financial institutions. It comes from real people who are inside the economy every single day. I'll see you in the next one.